Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, May 4th, 2022. It is 11:33 a.m. Eastern Time as I'm starting the video, and this is what I'm referring to as really day 4 of D week. On Friday I laid out the D-Day scenario and told you it would probably be a week-long process. We wouldn't know on Friday, more so this week, and today we have the big, highly anticipated FOMC meeting, and those what they do. We know we're getting 50 basis point hike, and then more so the market will be hanging and immediately parse through their statement, which will be released at 2 p.m. And then of course Powell gets on at 2:30 and does the press conference and answer some questions. So you guys know my thoughts. I don't want to beat a dead horse. I've laid out that we have bullish divergences across the board. We're still well off that most recent divergent low on the 60-minute chart. And here, yesterday, and that's all I'm going to do today is really get granular, stay down here on that short-term time frame. Yesterday I covered the short-term charts, 5, 10-minute charts, and 60-minute charts. We had taken out this trend line on NQ, but I told you I favored the breakout would fail. We were slightly above it right here. Said we had a BOD, benefit of the doubt, resistance level, and negative divergence. So I favored a short there for active traders, a rejection, a fade, and so far so good. We kind of stayed sideways, held above that. We had some minor support right here, danced above it all night. You can see here that's on a 10-minute chart. And then finally this morning, right after the open, I don't know where that chart went. Here we go. Right here, right after the opening bell, boom, that's what did the trick. We took out that minor support. I had it at about 1383, and then boom, nothing but selling since. Now remember, one thing that I can guarantee and already did is that you're going to see volatility ahead of the FOMC announcement and immediately after it. And so far that's volatility to the downside, and cuts both ways. We could reverse. This is where I guess the takeaway I want to do this video is, so far so good. If active traders, shorted that yesterday, and the fact we failed the breakout. I'm going to jump over to the 60-minute chart. Let's just do 1 month, show you that trend line. So this is that trend line that I was highlighting yesterday, the downtrend line right there. There was the breakout, proved to be a false and failed breakout, and we're down below what's a pretty important support. Now again, you have to take this with a huge grain of salt. That breakdown, both of the failure of the trend line and that yellow line, because the market's not going to pick its next direction until later today. And again, I always say this, the initial reaction after a Fed announcement, especially a well-anticipated one, is often not the lasting reaction. In fact, you usually get either a shoot up, or a spike up in the markets, or a spike down followed by a reversal, and then sometimes yet another reversal and even a third or fourth. So just try not to read too much into that. And here's the takeaway: if you are risk adverse, you shouldn't have any positions, or you should be very light or hedged up. You can reduce, take profits. If you've been shorting this market down at all the, tactical and strategic entries that have been highlighted in recent months, especially as a less active swing trader, the most recent here, scaling in here to here, and then shorting right there, the hard short at the 200-day moving averages, you're very profitable. Or maybe you've taken the whole thing down from the original sell signals back here. This was our original short entry on what I consider still one in the same trade. They're just trend trade. That's where we're at. If you're a trend trader and you don't game the rips and dips, if you're a regular swing trader, you game these rips and dips. And then if you're a very, very active swing trader, well, or a trend day trader, you step down to these 5-minute charts, and this is what you trade. You trade these, wedges and trend line breaks, and bullish falling wedge, positive divergence right there. Boom, that was a, big pop of about 3.5%, followed by, yesterday's short entry, which was also a back test of this trend line here. On the QQQ, I jumped over to a 5-minute chart, guys. Sorry if I don't mention it. It's always up here on the top on these charts. And boom, there it is. So either engage or disengage the market depending on your risk tolerance. There's always an element of gambling. I don't know which way the market's going to go, and I've already spent yesterday impressing in a very long video the potential for these divergences. You don't get them often. Last time we had an even smaller divergent low. The Nasdaq rallied, what was it, 13% or so. So that potential is there. And because we are in a larger bear trend, there's also the potential that these divergences fail to play out. And if they don't play out and we go much lower, that's going to be quite bearish. If you want to, things might move fast after the Fed today. So if you're looking for the next support on the more significant long-term charts, remember, I've been maintaining for months now since the Nasdaq peaked. Second target at 299. The line's at 299.15, so you want to call that maybe 300 to be safe. You know, you're talking on a 300 point security. 1 point is 1/3%. So you're not talking much. You always want to cover a little bit above there if that's your target. Remember, it also gets pretty thin. I talked yesterday about the volume at price histogram on another chart, but I'm going to show you this here. This is what QQQ looks like. The volume price histogram is thin, so we're going back. This goes back to 2018. I'll zoom into 2018. Okay, the beginning. So right here on the left of the chart is the beginning of January of 2018. So you have 2018, 2019, 2020, 2021, and so far this year. So all the trades that have occurred since that time, you can see the volume at price histogram bars are thick right here, thick up to my T2. So what this tells me is if that level's taken out, that's a pretty important support level, and we'll probably go on down unless it's taken out, you know, on a brief intraday or even intra-week break. And if you close back above the week, then you may get another rally. But again, we're getting close to my second target. So if we have a punch down after the Fed, you could cover there, or just trail it down and keep your eye on the prize if you are a longer-term trend trader, because if these divergences fail to play out for what they would normally project in a bull market, and let me be clear, I'm referring to the divergences on the daily chart right here, primarily on the daily. They show through on the 60-minute chart. If these divergences fail to play out for what they would indicate, which to me would be a move bigger than this one, because they're much larger divergences, you'd have that key, what I call bear trap right here, where the other day we broke down below. I always say don't read too much into breakouts, whether it's a bearish downside breakout or a bullish breakout that occur right before big market moving events and around earnings. We had all the FANGs reporting last week, and you have the Fed this week. So this is all kind of noise to me. I don't think, well, at this point, we're right on the line. Doesn't matter. We're a hair below. Again, I think we'll have some clarity on which way the market wants to go, whether these divergences are going to play out or get taken out. I think we'll have a good idea by the end of this week, would be my guess. Okay, and before I leave well, let me jump back to the weekly time frame. Let me turn back down those volume price histogram bars so they're not too busy on the chart. Leave them real subtle there. And just reiterate the targets again. S&P 500, if you're trading that, still maintain near-term second target of about 394.50. A longer-term target, again, it's all going to, if this long-term target's going to be hit soon being within the next few months, let's say, possibly even a few weeks, if things go the way that they might go, if these divergences just utterly fall apart and we take out these next targets, and that would be probably a quick ride down. I think you can probably see the same thing here if I turn on those volume at price histogram bars. Yeah, you sure do. On the S&P 500, it says over the last few years, almost all the trades have occurred right here in this little range up top, this potential topping pattern. And then, of course, down there around the time COVID hit and everything else. But it was a relatively swift move up with relatively thin volume all the way down there. And I'm still targeting in the S&P 500 and the Nasdaq 100. I'm still targeting around my ultimate bear market targets, at least to the point. It might not be the end if we enter a new secular bear market, but right now, just this, this trade before I really look to start putting a lot more long trade ideas out. I think we're going to move down and test those, what I call the pre-COVID lows, where the market was, where it peaked back in February of 2020 before the big drop. So that's it on SPY. There it is on QQQ. There's the pre-COVID lows, and that's exactly where my fourth and final target is there on that one. And then IWM, a little bit different. Here, let me turn these volume price bars down once more. And there we go. And you can see a little bit different because you have T2 is just my next target, and that's at those pre-COVID lows. And here's the thing. Again, we're already below a lot of my first targets on all the indexes, and which makes me think that's why, for one reason, because support is support until unless broken, and it's been broken. That was big support there, 192.15. It's the recent lows right here have been taken out now. This trading range, we're just below it, and that's why I favor this. So I'll be heading into the Fed short, despite divergences across the board, which normally is when I like to be long. And I told you guys before, and I'll say it again, first of all, I'm a more aggressive trader than some. I'll anticipate things before they even happen, whereas conventional traders wait for a breakout or a breakdown to enter position. Sometimes, I'll quite often do that, but sometimes I'll anticipate what's going to happen, a breakout or a breakdown before it even happens, and position accordingly, and that can, it can burn you at times, no doubt. It's contrarian, but it also can provide a much more favorable entry, especially when things move fast. Sometimes breakouts occur so fast, sometimes they occur in a large gap up or gap down, where if you waited till the big event, whether there was earnings or Fed announcement was out of the way, by the time you realize, okay, it went the way I thought, but guess what? It's no longer an objective entry because we gapped way up or we gapped way down above the breakout point. All right, let's just finish this video up real quick with the short-term charts. Again, take it in real tight. I'll start with QQQ. I already hit on that once. There was that bullish falling wedge, and then yesterday I showed you on the futures, and same thing on the ETFs. This is QQQ 5-minute chart. You had that divergent high, and you were also at resistance on the future, so that's where I favored a fade and figured that breakout would fail, and there's the fade so far. So probably from here, we pulled back. We dropped about 2% so far, pretty sharp down this morning. I really don't know where the market goes between now and 2 p.m. And I don't know for sure where it goes after 2 p.m., but you know my thoughts. One other trading tip. Again, this can cut both ways, but I tend to either remove or widen stops on positions, depending on the position, what I'm trading, of course. But something like the indexes, I'm more of a futures guy. IRAs and other accounts, long-term accounts, I'll use ETFs as well, and I'll always post them for you guys. But futures or ETFs, doesn't matter. What you're going to see is volatility that can run stops. And the key of any trade is to hit a price target. So let's just say, and I happen to be on this NQ hourly chart. Let's just say I had a price target right here and a stop right here. I might, and we're heading into the Fed. I might pull that stop, or let's just say here, and let's look at it as I would on a chart. You have resistance right here over these recent highs. I'm going to pull it in tighter and show you. And so a logical stop might be right above there. However, the problem with that, number one, is the algos know it. Humans know it. The big, market makers, the trading desks that have a lot of money to play with, they can run it up, clear those stops, and then take it down. So I will either widen stops or remove it, because the goal of any trade is to hit your profit target but not be stopped out. So in that case, if my price target's down here, I'll leave that in place. I want it visible. But I may pull or move up my stop. Now the problem, of course, the downside is you could keep going up, and at some point you're going to have to pull the plug, right, and say, oh, you know what, I was wrong. And then, of course, you can have a larger than expected loss. But again, this is just from experience. Over the years, decades of trading, I've had a lot of stops clipped on days like this where I was right on the move, but I didn't capitalize on it because I had it, didn't account for the spikes, the post FOMC volatility, or whether it's a stock on earnings, and so therefore I will employ that strategy. The other thing I do is, I don't know, a lot of brokers might not do it. Interactive brokers will allow you to hide stop orders. All my stop loss orders I always hide because, again, my goal is to not be stopped out on a trade, and it's to hit the price target. However, stops are necessary. Overall, I use them, but what happens is I don't want, especially, and this is most important, especially if it's a thinly traded security. Look, if I'm swinging the NQs and I have a handful of contracts, they may not, come after my stop. It may, and it takes a lot of muscle to move the Nasdaq 100 futures or the S&P 500 futures. But by hiding a stop loss order, it's still there. It will still trigger if hit. It just, your broker sits on it and doesn't send it to the exchange until it's actually there. So it's hidden. So it's not visible like the majority of other stops, everybody using Fidelity, TD Ameritrade, and everything else. However, I'll leave my profit target if it's a short trade and it's a buy to cover. I want that visible. I want them to see it and go down and fill that. So that's just what I do, and I think it helps. It can't hurt to help avoid stop rates so they don't see your stop. Maybe they ran up here and your stop. I always like to place my stops also slightly above the cluster where I think everybody else is placing them, because the stop rates, they'll go after them, clip everybody's stops. Mine's a little higher. But again, if I'm not hiding my order, they might say, oh, you know what, we'll take it up just a hair higher, get that last batch of them, and then run down there. And again, it's going to make a much larger difference on a more thinly traded stock, individual stocks, less liquid positions, or futures as well. Believe me, lumber futures, oh my goodness, always do that. Things like that don't trade as actively. All right, so to wrap it up, there's that downtrend line I gave you yesterday on NQ, about the hourly. This is the hourly chart, but I also gave you on the 10-minute. There was that divergence I highlighted yesterday. When we popped it, we had the breakout. I think it was a 5-minute chart. I showed you resistance right there. So a good short. That short played out so far. At this point, if you shorted there yesterday, you can have stops wherever you want. I just went over that. You could have stops at break even. You could have lower your stops to guarantee a profit. The levels to watch, just you can see them right here. And this is quite a band of, especially in the last 24 hours, a lot of trades right there in the top of that level. Let me drag a line down up. Grab this one from up here. I'm not using that. That's so high up right now. It doesn't come into play for anything I'm doing today. If we get that high, I will either be long or stopped out. I'm talking about the line I just pulled from up here. So that's about 13,150, probably the most significant level right now, very near term. Again, this is just micro analysis. And of course, we already failed the breakout right here. There was a breakout above the downtrend line, followed by a failure, aka bull trap. Longs would have bought the breakout yesterday, and now they're underwater, and their stops have been hit. Many of them, maybe not all of them. And now we just watch those recent lows. That's it. You want to go to the big picture. Again, just look at QQQ. Go to a daily chart, and we have 1, 2, and really all of this for the last week or so. That's why we haven't just had any type of waterfall selling, because you had all the big fangs report. They're out of the way. I didn't think the market would hold up this much for the Fed, but it is. And okay, so that is what it is. You can clearly see it's a stalemate, Mexican standoff between bulls and bears. Nobody wants to blink first. But I think the shooting will begin after today, later this afternoon into tomorrow, and then Friday will be a big day, especially if we start selling off or going up. Who wants to go? If we start moving up, shorts are going to get scared if we head into have a nice rally into the end of the week, and they might want to cover before the weekend. Likewise, if we go down, the divergences are burned through. Again, I think we're getting closer and closer to that, what I call POR, point of recognition. I mean, how much more? I got to give the bulls credit, you know. And again, I'm speaking metaphorically only because, you know, longer term I'm short, you know, go long short all the time, active trading, but you know, swing and in my views on the market. So again, they've been, you know, buying dips as they always do, and they keep buying lower and lower and lower. There just becomes a point where that's it. They realize that whole buying the dip thing that worked so great since March of 2020 just isn't working anymore, and that's when they capitulate, and then you don't see the buyers show up anymore, and that's when you can get a big leg down. So that's it, guys. Stay nimble. I wish those divergences weren't there. I'd be going a lot shorter. I can tell you that too. I'm not going heavy short into the Fed meeting. There's just these divergences are just too much, and they're still. Even though we had that little fade that I showed you there, here's another variation when I put on the 60-minute chart of QQQ. There's a downtrend line right here. If I draw it this way, it's nice and clean. It comes off this high right here. That is the high of, if you want to replicate it, April 21st. 3 distinct reactions. It's a little different from the one on the futures that I showed you. And so a pop of that gives us, you know, you have the downtrend line and the divergence. That takes the shape of a falling wedge. And a pop of that would be, you know, bullish, especially if they can build on those, you know, hold the breakout and build on the gains. And then I already went over this yesterday. You have a mountain of resistance overhead. First big level comes minor. I'll tell you the ones that come into play if you're looking to either short bounces or buy breakouts above resistance. Here are my levels that that I think are most important. 322.91. I'm just reading the actual number and round that off a few pennies. 329.80, and then 335.83. That's QQQ. Let's not forget, Q isn't the entire market. The S&P 500 also has nice, fat, clean, positive, aka bullish divergences here on the 60-minute chart, and you can do the same downtrend line right there off that same high. So these are your levels. The most important levels to watch today to me are these downtrend lines. Of course, the recent lows crap out, you know, just solidly take out the lows and then take out the divergences. Remember, we can make a marginal new low and still have the divergences. That would look like this. Say there's a little panic selling after the Fed, and then they turn around and buy it up. You're going to, as long as these divergences are intact, there's still the potential for a breakout there. All right, those are the levels. Let's wrap it up here. Keep it simple. And I will most certainly do a follow-up later today, either before the close or after the close, depending on what happens. And this is what I'm really hyper-focused on today, the markets. I'll do updates on gold and silver and natural gas, crude oil, and all the other things I usually cover later. But right now, I don't see a lot there. There's really not too much to point out. All right, wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.